Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. As many of you know, the greatest podcast on earth went to the greatest outdoor show on earth. In the Money with Amber Kanwar was at the Calgary Stampede last week. And if this was back in my BNN days on network television, I might have had a crew of 7 or 8 people involved, making sure it went off without a hitch. But for this humble little production, it was just me and the greatest executive producer on earth, Jillian Glickman, and I'm forcing her back on camera to talk about our reflections. I'm always optimistic, and I say that was great, and that's easy for me to say because I just do my interview, and then you have to handle actually getting it out to the world.
Right. Well, first I need to thank you for that intro. It was very kind. And I don't think that's fair because you were like quite involved in the nitty gritty of this one too. But I think for our first, on location experience, it went really well. And we were really lucky though, because we had a great team working with us from ATB Financial, our wonderful hosts. And not only were they great, but they were also so nice. They were so nice.
To the point that I fear that I'm going to lose you to Calgary.
Yeah, I really liked it there, like a lot. I mean, I'm not going anywhere, but I mean, I kept joking about it when we were there.
And I was then I started pointing out all the negative things about Calgary, even though I loved it too. The people were so warm and so lovely.
Yeah.
And you were talking about bringing your family to the next one.
Yeah, so that's true. Next year, I'm going to bring the whole crew. So it was great.
I'm not going to do that. All my kids are going to stay home while we do that show, but I think it's going to be an annual thing. And we made such waves with this interview with Adam Waterous of the Waterous Energy Fund. You can find it on YouTube right now. And in fact, I think we even moved the stock because Waterous revealed that if he didn't get Meg Energy, he'd pay a $10 per share special dividend. The stock was up 9% since our episode came out. So as I like to say, you're either in the money or you're in the dark. So you cannot afford to miss these episodes, including this one. On the show, I've got Gordon Reid of Goodreid Investment Counsel. He's Canadian, but he focuses exclusively on U.S. stocks. Does he think U.S. exceptionalism is over? Let's find out. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. Investing with confidence starts with knowledge. This episode is sponsored by BMO Investor Line, which offers a wealth of educational resources through their Investment Learning Center. Now, whether you're just getting started or looking to refine your strategies, the Learning Center can help you make informed decisions. Combine that with their easy-to-use platform and commission-free ETF trading, you'll be well on your way. Gordon Reid, thank you so much for joining me on the show.
Thanks, Amber.
So you focus on U.S. equities, and it's so great to have you at a time where I think the great debate right now around U.S. stocks is U.S. exceptionalism over? And you've been doing this long enough that you've lived through a cycle where U.S. stocks are not in vogue, which
Correct.
For young millennials like me, we can't even picture what that looks like. So maybe give us a sense of first your history in the markets, then we can go about kind of answering that question.
Well, my history goes back into the 1980s when I first started managing money, and my focus was on the U.S. side. Previously to that, I had been a manager of a corporate finance area with a large multinational, which included, of course, non-Canadian exposure. And we filled file drawers full of acquisition studies, most of which weren't acted on, but many were. So that piqued my interest in the U.S. side. And of course, the great diversity and opportunity to look at the U.S. and invest in the U.S. is very exciting. To your question about exceptionalism, I think is an evolving issue. There have certainly been times when exceptionalism or U.S. exceptionalism has faded. And I believe it'll continue to exist, but to various degrees. I think that there's a big opportunity in the United States simply because of resources, primarily capital, in the AI revolution. And perhaps we'll get into that later, but But that's a very big opportunity for them to move again into the forefront.
And when you talk resources, you're not talking about how Canadians think about resources,
No.
which is like oil and gas. You're thinking
I'm
about
thinking about capital.
Yeah, actual dollars moving in.
Yeah.
So that's really interesting because I think people struggle with the idea of this AI revolution because they look at valuations. They look at Nvidia worth $4 trillion and they think, it already happened. Look, Nvidia's $4 trillion. That's never happened in this world before. So how do you think about what point of the cycle we're in?
Yeah, I would respond that if you look at the first part of the technology revolution, going back to the introduction of just the personal computer and evolving out of the IBM, what was it, 360, I think it was, and I lived through this. I lived through working for a company that had designated floors of office towers that had to be cooled, and they were just the computer floors. And of course, the horsepower was a fraction of what it is today. So I think what we're living through today in terms of the AI part of this technology revolution is the hardware infrastructure plug and play type thing. We haven't yet gotten to the real application that affects all of us in our everyday lives. We've scratched the surface a little bit, but I think it's going to be pretty impactful, and it's going to impact not technology companies exclusively, but companies that utilize technology to enhance their own benefit or for their own benefit.
We've had people come on the show to talk about the AI revolution and stocks, and on one hand they'll say, the AI revolution is absolutely real, but even if you use the .com era as an example, the internet was very real. That doesn't mean internet stocks did well, right? And for years, they actually didn't because the exuberance faded. And so some who are bearish draw those kind of parallels that the same thing will happen this time around.
Well, if they were here today, I would say, okay, well, let me take away the things that you don't think benefited you, like search applications. So you no longer have the internet. You no longer can hail a ride share. You can no longer text with your friends or hear your wife wanting to get these groceries on your way home, and so on. And I think if we went down that road, we'd quickly realize that all we've done as human beings is adapt and take for granted. But the revolution is real. Our lives are changed. Imagine our grandparents stepping into our shoes. Their mouths would drop open.
And so that explains, why Nvidia is worth $4 trillion and why the S&P 500 as an index has become so concentrated in tech. But there's, the other 493 stocks that are also merit study and are out there doing their own thing. How do you balance? And of course, we're going to get into the weeds on actual stocks, but how are you balancing your tech exposure with everything else?
Yeah, carefully. And you don't want, as a money manager, you've always got to compete. It's fine to have reasons and excuses for not living up to certain benchmarks or expectations, but that will only take you so far. So you have to compete. At Goodreid, we took the approach that this was very real. These were great companies. We wanted to participate, but for quite some time we've been underweight the index. And what that means is that the other 493 companies in our world had to outperform, or we were going to be underperforming our benchmark. Fortunately, we've outperformed. And what that means is that we've chosen amongst the other 493 carefully and successfully.
And I guess that gets around the other complaint, which is that the market is expensive. Because when you are factoring out the valuations of tech, how do you think about valuations of the remainder of the index?
Well, they're trading at a less expensive multiple, about 5 multiple points less than an S&P 500, of course, which is inclusive of tech. Does tech deserve a premium valuation? In some cases, yes. And we own companies within that space. And I would cite Amazon and Meta as a couple of them that are growing at multiples of GDP that the other 493 aren't. So do they not deserve a premium multiple? So if you X the Mag 7, we'll call it the Mag 7, perhaps that's fading, and look at the other 493, do they deserve, say, a 17 multiple in this environment? I would say, yeah, it's okay, but I wouldn't say the market is cheap. You have to look back and say, 2.5 years ago, would you have taken a 2024 that gave you a 25% return and or 2023 that gave you a 25% return, a 2024 that gave you a 20-something% return, and then this year to date we've got about a 6% return, which is almost bang on a historical cadence. So interestingly, in preparation for the show, I went back and looked at our Goodreid gauge, which is on our website, goodreid.com. And this is a commentary that we write quarterly. In December of 2024, I said, listen, after 2 fantastic years and perhaps a full basket of valuation, we're not cheap. This year will probably be defined by an average return, but with greater volatility. And here we are.
Well, Nostradamus, that turned out to be correct. And others have made that point that, the catalyst for the sell-off was tariffs, but it could have been anything.
Yeah.
That
I agree with that.
Derailed things. Well, that's because then I would love to get your perspective on tariffs. As somebody who is kind of more bottoms up than a macro thinker, you have to do the homework on what are these companies saying about tariffs? How is it going to affect their margins? Are they going to eat it? Are the consumers going to eat it? What are you doing with the threat of tariffs? There's the application of tariffs and there's this threat of tariffs.
Yeah. Well, to analyze that, I think correctly, we have to go and look at the politics of the day and the unique individual who's leading the charge in Donald Trump. And, his strategy is now being flushed out fairly clearly. His strategy is one of disruption, creating confusion. It's a chaotic strategy. He wants to keep his opponents off balance. And, he's very effective at it. He's done it his entire life. He's an intimidator. And whether we like it or not doesn't matter. It is what it is. So how, as an investment manager, do we approach that? Well, we didn't do anything. We watched. And
so the big plunge in April did nothing. The big recovery, still nothing.
Yeah. And again, go back to our Goodreid gauge at the end of March. What I did was I cited 5 years ago, almost to the day, which was, of course, the pandemic. And I said, completely different circumstances. Of course, a massive worldwide health scare versus a tariff situation. But from an investment standpoint, a huge unknown. So how do you deal with the unknowns in the marketplace? And what I've learned in my 35 years in the market is you be patient and know that the reality of today almost certainly will not be the reality of tomorrow. And don't assume that to be successful, you have to know the reality of tomorrow. What you have to do is buy, again, bottom up, good quality companies, watch them carefully, make sure that they're not destined for a dramatic change in their fortune, but that happens rarely. Watch, wait, tread carefully, act when you have more information, and that's what we've done at Goodreid.
All right, well, let's see if we can find some of these names and dip into the mailbag. Okay, our first question in the mailbag is Novo Nordisk. What is your take on U.S. pharma with upcoming tariff threats, especially Novo? This one coming from SamCam123 on X. I feel like those are two separate questions. Let's maybe talk about healthcare in general.
Right. Tariffs
are just like one of the things that these stocks are faced with, and then we'll take Novo.
Sure. Well, I agree with that healthcare has been in the doghouse for a long time. And when you look at why, I think that broadly speaking, healthcare is at least a damaged model, if not a broken model. There's billions of dollars invested in research and development for these drugs. And then under the legislation that we have in place now, which goes back to the 1980s, there's a patent cliff. So all of that money that you've spent and you're now trying to monetize has a clock ticking on it. And what the model has shown is that these huge pharma companies just pedal like crazy to keep up, and then bang, over the cliff they go, and they've got to replace that revenue stream. And what we've seen is the very large pharmas have really not been able to grow organically. What they've done over the last quarter of a century is basically consolidate, which is a cost-cutting move, and acquire. And they've acquired companies that they think will give them a bit of a two-step forward type advantage in terms of development with mixed success. So jumping into Novo, I mean, hugely successful with their GLP-1 technology. But here we are.
This is Ozempic, the Ozempic maker,
yes.
you know.
And the competitor to Lilly.
Yeah.
You know, Novo is interesting, and the compare and contrast is interesting because here's Lilly right now trading at about 35 times earnings, but it's down from about 50. And Novo is trading somewhere in the mid-teens multiple, but their stock price has been halved. So the bloom is off, and people are looking at it and saying, well, is there a finite sort of process here with these drugs? Is the total addressable market as big? Are they going to have as much of a piece? Is their delivery system going to prevail? And then we get into the tariffs and so on. But to your point, Amber, tariffs is just one of the things. Maybe it's number 5 on the list of concerns, but it's one of the concerns. But I've looked at this industry carefully. We don't own either Novo or Lilly.
It sounds like you don't really like pharma in general.
You know, we own a little bit of pharma in Merck, which has not been a good investment for us. You got to be full out on that, and you know, but it should be. I mean, there's another example. They've got Keytruda, which is just a fantastic drug for humanity.
What does it do again?
It's an oncology drug.
Yes, cancer.
But there's a variety of drug cocktails that have been designed to treat different types of cancers incredibly successfully. So for society, it's been a wonderful thing. For the company itself, it's been great, but it's more and more dominant in their portfolio. I think it represents, I have to look this up, but I think it's probably in the low 50% of their total revenue. This is Merck. I mean, this is a huge pharma. And they're...
I know. I'm a bag holder in Pfizer, which I feel like is the same situation.
Same situation.
And you know what? I bought Eli Lilly because I felt like, as compared to Novo, at least they've got robust Alzheimer's sort of platform. But Novo is sort of this great case study in like momentum on one particular drug, and it takes you to a certain point. You could have doubled, tripled your money just by holding it for 2-3 years. And they're still growing. Like in some ways, Ozempic hasn't reached market saturation.
Right.
And yet the stock is off so huge. Yeah. Is there a lesson in there about that kind of momentum investing?
Well, there's certainly lessons in momentum investing, but it's also, you know, the stages of investing that we have to recognize that the early stages, where, you know, some people label it the easy money, really comes at a conceptual level. So there's a euphoria about the broad issues. So people talk about TAM, total addressable market, and I go, oh, the TAM is like $1 trillion. And somebody will say, no, it's $2 trillion. And it doesn't really matter because it's the enthusiasm and the euphoria that's driving the stock. The precision of the numbers only comes at a later stage when people hold their feet to the fire and say, you know, and you get to the nth degree or the complete opposite of that euphoria where you miss by a penny in a quarter and they slam the stock. And you know, what happens from point A to point B, from euphoria to the precision of having to hit certain points in time? Well, it's all behavioral. It's all how the investor thinks and what they think is required for the next X percent.
And pharma, I think you have to generally be a little bit maybe higher risk tolerance, especially if you're in some of the biotechs. I think people thought insurance was less of that, which leads us to our second question. Why did Elevance go down so much with the Centene news? I bought Elevance. I thought Elevance was much more insulated from the recurring Medicare, Medicaid headwinds. Is it time to buy more? This one coming from Dean in Ottawa. The backstory is these insurers have been under a tremendous amount of pressure. And at the beginning of July, Centene shocked the markets by pulling their forecasts altogether because they had completely miscalibrated what they thought they were going to pay out relative to what they took in. That's a simplistic way of putting it. And Centene dropped like more than 30% in a day.
In a day.
These are not stocks that are supposed to do that.
Right. And to say that Elevance was affected is fair, but I would push back on somebody who say, well, Centene and Elevance got slammed on that day. If you look at the actual numbers, Elevance fell in sympathy with Centene, as did the rest of the healthcare insurers, but, I forget the numbers, but a fraction of it. This is a story of a sort of dislocation in this industry that started with COVID and with the healthcare system in the United States. The eligibility for Medicaid, which is a catch-all for people who don't have insurance and need help.
So this is kind of Medicaid is the lower income health insurance.
Lower economic strata. But the enrollment ballooned because COVID was so disruptive. There were a lot of people who lost jobs, who all of a sudden became eligible. So there was a huge enrollment, which of course helped the insurance companies. And on top of that, this incremental enrollment tended to be not old and infirmed, but young and healthy. They lost their jobs, so they need help, but they're 28 years old and aren't on any medication and don't have any procedures to be done. So it's highly profitable for these companies, and they're all trying to recalibrate to catch up. Centene has a much greater exposure to the Elevance because Elevance's model is much more of less risk of a risk model and more of a subscription model. And by that I mean that within the 45 million members of the Elevance group, somewhere close to 30 million of them are part of this subscription model where Elevance doesn't take on full risk. There's almost like a reinsurance program that happens because if I come to you, Amber, and I say, well, here are rates for your company and its employees, and you push back and say, well, hold on, we have a lot of young employees who are very healthy and these are high rates, what can we do? Elevance would say, well, what you can do is take on some of the risk, we'll lower the premium, but if you go over certain thresholds of claims, then it's on you. And that's what's happened. So Elevance is much less impacted by all of this.
And yet it's trading at a 4-year low. It sounds like you would step in here. You'd buy the dips on this.
Already have.
Okay. Yeah. And it's not affected by any, or is it minimally affected by the budget cuts to some of these programs?
The budget cuts are intended to basically get people who shouldn't really be on Medicaid off the enrollment. And, it's been highly politicized, but that's the basic intention here.
You're talking my language because my toxic trade is buying stocks at 52-week lows. I'm so tempted. I'm curious if you did the same with United Health.
We've never been a holder. Well, we haven't been a holder of United Health for decades, so I'll say we aren't a holder. United Health in a similar business, but much more exposed because they don't have as high a subscription risk percentage. They trade 4 or 5 multiple points more expensive than Elevance. And for people who sort of think Elevance, what is that? This is the old Anthem. Yeah. That some people might go, oh, really? And they changed their name. Not sure they did it well, but they did. So this is a big company. It's not like
a new upstart company.
No.
It's just okay.
This is Blue Shield, insurer in the United States. Yeah.
Okay, so buying the dips on Elevance. You're a shareholder in Visa, if I'm not mistaken, and we got a question on whether you like the credit card companies in general, whether you'd continue to hold on Visa. I mean, that stock is trading near a record. There were some concerns as like stable coins made a big splash. Are stable coins going to disintermediate Visa because now you can just transact, Amazon can now just transact directly with its consumer and they can cut out the credit card companies.
Sure. And every company has challenges and no moat is wide enough for me anyway. But Visa is a wonderful franchise. A lot of people ask about Visa versus MasterCard. We've chosen Visa and been a shareholder for many, many, many years and have done very well on behalf of our clients with it. It trades a little more cheaply than MasterCard. And, you talked about a 52-week high, which is true, or very close to it. But when I look at a stock, I tend not to look at stock prices. I look at valuations because the worth of a company isn't in the number. It's in the number of dollars I put out for each dollar of earnings or each dollar of cash flow or each dollar of sales, because everything in this world is a relative measure. So if I'm paying $1,000 for something that gives me $100 of earnings a year, I'd rather do that than pay $500 for something that gives me $10. It's just a better value. So we don't concentrate on the actual dollar value and whether things are at an all-time high. I would say Visa right now is about 30 times forward earnings. It's traded more expensively in the past, and that gives me some comfort.
That's good perspective because you could have said it's at a record high like in the last 10 years at each point and still missed out on the rally. One of the other things that kind of knocked these stocks down more recently was concerns, reports that the banks were going to start charging a Visa or any fintech for access to consumer data, which I didn't realize that they weren't charging for.
Yeah.
But that I guess the concern that, expenses were going to start to go up for Visa. How do you think about that? It seems like investors are just jittery. They take these reports and they sell them.
Yeah. Well, I think you have to look at who's got the interests here. So Visa has how many? I think they're at about 7 trillion transactions a year, and this is just money for the banks. So the banks, basically are the risk takers. Visa is just the toll taker. I mean, they don't have any credit risk, but they facilitate spending through merchants, which of course is the revenue stream for the banks. So, there's always going to be negotiation, Amber. I'm not saying that there's not, and there's give and take and there's push and shove. But credit card companies have been the target of interests who want them changed for many, many years. I remember Dick Durbin was a U.S. senator from Illinois, recently retired. He spent his entire career going after the credit card companies. And I won't say that Dick Durbin didn't have a successful career, but I would argue that Visa has had a better run than Dick Durbin did.
Good perspective. Our final one before we take a quick break here is RTX, defense stock.
Yeah.
Also had a tremendous run. I think it's at a record high today, actually. Is this just a pure beneficiary of like increased defense spending around the world?
That's part of it. I think in an ironic way, that's the stability of this type of business is that, defense spending in the United States isn't going anywhere other than up. And it's going to be tied to GDP growth. I think there's an aspect of spending on defense ex-United States that is an interesting topic. And we've heard it here in Canada, of course, with discussions about defense going to 5% of GDP and over through Europe, the same thing. That's going to help RTX a lot. But of course, RTX is a fairly new entity. RTX was the defense company, most famous for its Patriot missile. But the other side of the business is United Technologies. And United Technologies is a commercial aerospace company. Pratt and Whitney, Goodrich, Collins Aerospace, and that gives a bit of a buffer and almost a bit of a growth aspect to what is the stable part with RTX, the defense side.
With the stock at a record high, would you add here, or is a multiple of 26 times rich for what it is?
No, I think it's a fair multiple. I think it sort of is in that basket of, you're not likely going to get a lot of multiple expansion off a company like RTX, but I could say that about a lot of companies, especially industrial companies in the United States. But you still have the opportunity for organic growth to propel stock prices without changing the multiple. So we continue to like RTX. We added to it a few years ago when they had their issue of a contaminant getting into machine engine parts, and the stock dropped precipitously. We've seen that in the past a number of times. A lot of times have taken advantage of it because disappointment and reputational risk tends to dissipate over time. If companies handle it well, the reputational risk, the shock to the stock price starts to dissipate and it recovers. Most recently, we did it with CrowdStrike. A year and a half ago or a year ago.
It feels like more than a year ago.
Feels like a long time ago.
Yeah.
But anyway, they had their issue with the software bug.
Basically, they caused like this global outrage. So it was like related to Microsoft. Blue screens everywhere. And, no, you're right. It was just like a year ago.
Yeah, and the stock dropped, I think, into the 230 level.
Yeah.
Well, we bought.
Do you want to know how much it's up since then?
Probably up about 80%.
120%.
120. Okay.
There you go.
Yeah. Yeah, so we took advantage of that. So that's sort of part of the trading aspect of what we do.
Okay, we're going to take a quick break. When we come back, we've got all tech stocks in the mailbag. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 250 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary products to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, we're back. Let's talk Microsoft and Apple. We've got a question from Stephen and Barry who wants to know your thoughts on investing in CDRs versus the actual stock trading in the US, such as Alphabet or Microsoft. CDRs is Canadian Depository Receipts.
Yes.
So basically you can buy it if you have a Canadian dollar account. You can buy these stocks. How do you think about that?
We have chosen to use currency to our benefit and our clients' benefit by giving them another asset class that they can use. Now, our circumstances are perhaps somewhat different from others. The average investor with Goodreid has a couple of $1 million with us. Our minimum investment is $500,000. This isn't small amounts of money that you want to protect because you're looking to fund Canadian sort of expenses and that type of thing. These are assets that are multi-generational. They're legacy assets generally. So we've chosen that approach. I can't say that I have a lot to criticize for people who want to use CDRs, but you have to understand that basically for a small cost, and it is a fairly small cost, you're hiring somebody to hedge out the currency risk.
So you do that with other instruments versus buying?
We don't do that at all.
You don't do it at all?
We want the currency exposure.
Okay.
And we want the currency exposure because our feeling is that if we're going to invest in an economy like the US, that if you've got a problem with the currency, you better take a step back and think, well, why am I investing in US companies if I don't even like the currency of the country? So we have long ago overcome that hurdle.
And you remain resilient with that, given even with the US dollar pulling back, trading around 3-year lows. That hasn't.
In the time that I've been investing, so let's go back 35 years, the dollar has been as low as 60 cents and as high as $1.07.
Yeah.
If you go back to 1986 and look at clients who started with us, and to be honest, we don't have anybody with us who started in 1986. The oldest client still with Goodreid dates back to 1989. But they've made something in the order of 55 times their money.
And so, yeah.
It makes currency a non-issue.
Okay, let's go to our second question, which is about Uber. Gord, you were correct in believing that Uber was mispriced in the mid-60s and undervalued. This was 8 months ago. What is your feeling today when it comes to value? Do you still own it? Is a target of $115 per share still feasible over the next few months? And Uber right now is trading at around $94 a share.
95, yeah. We still own Uber. We did feel that it was mispriced. In a lot of ways, it was mispriced because there were fears that the whole model of ride sharing was going to change, and Uber was going to be put out of business by a Tesla, by autonomous driving of autonomous vehicles. And we thought that binary view of win or lose was nonsense, that companies like Uber would adapt. In fact, I wrote a blog around this time, and you can find it on our website, goodreid.com. Go into insights and articles, and it's a Goodread blog. Many things there that you can look at if you wish, but Uber article is one of them. And the point of the article was to say that Uber understands the competitive landscape. Over 15% of their fleet is already autonomous vehicles. They have strategic alliances with Waymo, which of course is the Alphabet autonomous vehicle drive sharing. Waymo is the car.
Yeah.
They're also dealing with GM on the OEM side. And the dynamics and the fundamentals of Uber are incredibly exciting. So as I point out in the blog, they're growing at an incredibly rapid rate, somewhere north of 30% compound growth of earnings, which is...
And they're diversified. They've got ride sharing, but they also have Eats, which look at my bill.
Yeah, exactly.
It's doing quite well.
Yeah, and of course, when you look at your Eats bill, you think, well, how did $60 become $105?
Yes.
Well, that's to the benefit of Uber Eats. And they also have freight and they have advertising. They have 170 million people who have downloaded their app. So the opportunity there is really nascent. They haven't really taken huge advantage of that.
I'd love to get your thoughts on driverless cars and whether, it seems like you're all in on the AI revolution. I heard, it was Malcolm Gladwell speaking about driverless cars, and he made this interesting observation and noting that if you're in a Waymo and a kid runs in front of the car will stop. But if a kid decides to mess around and just run around that car 100 times, the car won't go, right? And part of what keeps pedestrians behaving is the fear of accidents. But if the cars behave so well that pedestrians become sort of lawless in major cities. And basically his idea was just based on how humans behave, he doesn't think it takes off to the extent that people think it is. And that really made me think. I haven't been able to let go of it. I don't know. Do you see a future where everything in the city is all autonomous driving?
No, because I think that people will want to determine and direct their own actions.
Yes.
So some people will not give up my son is a good example. He has two little girls at home, and he drives in. He's not thinking, oh, rush hour and gridlock. He's thinking time away with my coffee to think about other things.
Yeah.
And so everybody wants their own space and has their own reasons for doing different things. But I read an article a while back that basically made the case that at its full potential, driving and the elimination of the human driver is getting rid of the bug. So we are, in a technology sense, really the flaw. And are
From
we going
a
to
safety perspective?
Are we going to get there? I
Yeah.
don't know, and probably not fully. Nothing works 100%. But I think that there's a huge opportunity there. And think about it from Uber's management standpoint. An autonomous drive Uber is half as expensive per mile as one with a driver. So an AI taxi is going to, be, or an AV taxi is going to be much more efficient. Plus, it doesn't get tired. It works 24/7. So there's a lot of things from a financial and a resource standpoint that people are driving towards. They want to achieve. Whether you get there 100%, I think, is doubtful. But I think it's going to be enough so that there will be successful companies, of which Uber will be one.
And what does it mean for the stock, do you think?
Well, that's the other part of the question. I often get asked, will it reach X dollars? And I don't know how this viewer came up with 115, but I would say it's in a way a little bit destructive to your long-term thesis of success if you put a number on it that is determined by your own experience with a stock. So
you don't do stops?
We do not. We don't do targets. I remember years and years ago, I had a financial professional call me, and I think it was Coke we had bought, and I forget the numbers, but let's say we paid $30 for it. And she said to me, "So you bought Coke?" And I said, "Yes, we're excited about the future for the company." She said, "But you paid $30?" And I said to her, "I take from your inflection that you own the stock and you paid less." And she said, "Yes, I paid 20." And I said, "But that's great. Congratulations. But remember that when you paid 20, somebody out there said you paid 20 because they had paid 10.
Yeah.
So if you introduce your own experience with the stock, you limit the opportunity of the stock. So we've got many stocks in our portfolios that have 5, 6, 8, 10 times growth. So, it's fantastic. The old Peter Lynch 10-bagger comes to mind. He was a famous money manager in the 1990s.
Yep.
But this is what you want to allow your portfolio to do. I think what a lot of people fail to recognize is that most successful portfolios aren't driven by the mass of the portfolio. They're driven by enough of the portfolio, a few stocks that drive it and carry it. And, the old, I guess it was Warren Buffett or Charlie Munger who said that diversification is the enemy of performance, and you think about that and you don't want to take it to its full extent. But it's true that in most portfolios, a few stocks create all of the alpha.
I'm going to propose a blog post for you. I'd love to know from that person who's been with you since 1989, who's up 55 times, how much turnover was in their portfolio. Because it sounds like if you stuck true to your method, that maybe there wasn't a lot, that it was just
less than average.
Less than average.
So our turnover rate has run historically at about 25%. And I'm always shocked to read the industry numbers where the average mutual fund in the United States turns over almost one time a year. So 100%.
Wow.
4 times what we do. There's no answer to the question, what is the right turnover? But I think it has to be based on rigorous sell disciplines and not just what did I read in the paper this morning or how do I feel today? And I think, unfortunately, my experience is that a lot of investors are driven by the latter. They're driven more by behavioral aspects rather than discipline, and that can hurt.
Okay, well, let's see how this applies to some of your top ideas. Let's get into pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. So all your pro picks, Gordon, have a theme. They are all financials, U.S. financials. And before we get into them, maybe talk to me about this sector and why it's so exciting, because this is a big week for U.S. financials. They're all going to start to report their results. And I would say if it wasn't for tariffs, we would think everything's great. There's no credit quality issues. You know, investment banking is starting to come back, but it's not going bananas. But then, you know, there is that anxiety about tariffs and interest rates. Right.
So I picked the theme because I think this is one industry that really hasn't participated in the last couple of years of market performance. These are companies that, if you go back to the great financial crisis of 2008, have had to sort of recapture their credibility. Like a lot of companies, they're going to take advantage of whatever they can, cut corners, and there's probably more risk there than meets the eye. And the same was true in 2008 when, of course, the banks got caught and, you know, it was pretty bad.
Yeah.
So what happened was the regulators put their foot down and through worldwide regulation mandated that these banks increase their capital levels and pass yearly stress tests that test a scenario of Armageddon, like terrible. And that's led to these companies, this industry, being the best capitalized they have been in their history. So where we are now in 2025 is that we've got an administration in Washington that is saying we're overregulated, we've got to pare back, we've got to release some of this capital, and it will become more productive for these banks. These banks are trading at historically, I won't say inexpensive, but not demanding multiples. So, you know, the big major money center banks are trading somewhere between 13 and 15 times earnings. They're trading at anywhere from 1.25, 1.3 to 2.2 times book. So, you know, reasonable, but they've got a huge runway ahead of them. What's happening? Well, we're in a very active environment economically. You know, people are worried, but people are always worried. If you look at it, we've got good employment numbers. We've got an inflationary environment that is cooling off the COVID experience. And I would think that given what I've said about AI, that there's deflationary aspects that are right ahead of us, which is going to allow corporations to expand margins, which will boost the ability to grow multiples. You've got interest rates which are fairly low historically and poised to fall lower. Well, why are they poised to fall lower? Because almost everybody who has any power wants them to go lower, starting with the President of the United States. And you have to remember, even though if you say the Fed is independent, the president is the one who decides who's going to be Fed chair. And
so you don't get fussed if it's July, October. You just know directionally this is where it's going.
Absolutely. Now, it's going to go lower. Sorry, I keep talking, but it's going to go lower. Interest rates are going to go lower. But monetary authorities really only control the short end of the curve. The long end of the curve is controlled by economic forces and the bond market, the bond kings. So what is likely to happen if short interest rates are forced lower artificially, that is by people who just have an interest in them being lower, you're going to get a sharper and a steeper yield curve.
Which is good for the banks.
Which is good for the banks.
Because they lend long, borrow short. So their interest rates will be lower, but then they make more on the back end.
Make money the good old-fashioned way.
Okay, let's see how we apply this in the portfolio. Your first idea is Goldman Sachs, which reports this week. It's had a huge run, sitting near records. Let's talk valuation. Let's talk catalysts. Why do you see it going even higher?
65% of their business is capital markets business, so investment management. What we've seen thus far is that the great capital markets boom that everybody was predicting has been delayed. It's been deferred. Why? Because everybody's afraid of tariffs, and nobody in the boardroom wants to pull the trigger because they just don't know what tomorrow will bring. What we've seen is a lot of deal flow, but big deal flow. So $1 billion plus, but smaller companies aren't acting. They just can't afford to be wrong. But that will come. Once there's more stability, once the visibility is there, the capital market cycle, we believe will be very, very strong, which is great for Goldman Sachs. That's the bulk of their business.
And the breakout happened after kind of years of meandering, right? And languishing for the stock. It finally got its mojo back under its current CEO, David Solomon. And remember, there were some anxieties around David Solomon and whether he was the man for the job. Did you ride the stock out through all this? Has this been a long-term hold for you guys?
No, we bought it a few months ago.
Okay, so it's new.
It's new, and we've done very, very well with it. Boy, Amber, I don't have it right on the top of my head, but I would say we probably bought it somewhere in the low fours.
400s?
Yeah.
Oh my goodness. Maybe a little higher because the low in April was like around let's call it 460. Okay. Goldman. Yeah, so now you're up like 52% in that. You don't get scared by those big gains in a short period of time?
You love big gains, but if the fortunes of the company have kept pace, you're okay. There's an understanding that as the price of anything rises, its value tends to drop, but that's not always true. If you have a stock that rises 50%, but its earnings rise 60%, it's a better value at the higher number than it was at the lower number. But I wouldn't say that's the case with Goldman Sachs. I would say that the valuations are less friendly today than they were when we bought them, but not meaningfully so.
Okay, and talk to me about Morgan Stanley, which is your second idea. Does it benefit from all of those tailwinds as well? Is there something extra special about Morgan Stanley or different?
Well, a little bit different. They do benefit from capital markets business, but unlike Goldman, where 65% of Goldman's revenue come from capital markets business, about 35% of Morgan Stanley's comes from that area. They've built a wealth management shop. They started that, Morgan Stanley was always known as sort of a fixed income specialist, large institutional manager. And they flipped that right around, starting back about 15 years ago with the deal with Citi. They took on Smith Barney, and they've added E-Trade, Eaton Vance, to the point now where they have about $5 trillion under their wealth management umbrella.
Which gives them more stable, less volatile access to income. That's
correct. And it also leads to slightly more demanding valuations. So they trade at a little bit more of a multiple level. I think Goldman's at around 15. I think Morgan's at around 16. Goldman's at somewhere around 2 times book. Morgan Stanley somewhere around 2.3. So, but one would expect that. A new CEO at Morgan Stanley, and Ted Pick, who's been there for many, many years, but has just.
And is this a new buy for you too, or you've owned it?
No, we've owned this for a number of years.
How did you think about, or did you think about the CEO change? Because I think, when you've had like James Gorman, who's the former CEO, who's been there for 13 years, right? Becomes synonymous with those changes at the bank, helping it rebuild after the financial crisis. And then you put in someone new, even if he's been with the bank, that is a transition to manage. I remember there being anxieties around it.
Yes, and James Gorman was no shrinking violet. It was his way or the highway, and given that Ted Pick worked for him and survived, he was a disciple of Gorman's. You had to think that the playbook was going to be carry on, and that's exactly what we've seen.
Your third pick, less of a household name, not trading as well, but maybe that's where the opportunity is. Jackson Financial.
Yeah.
I know less about this one, and it's a smaller cap, $6.2 billion.
Right. Well, at Goodreid, we have two U.S. mandates, one a large cap, one a small cap. And, it's a different world. We've run both for decades. The large cap started in 1986 and the small cap in 1992. So very, very long track records. But we populate the small cap with more names because we've got more company-specific risk in smaller names. So we offset that with more names. So offsetting non-systematic risk with systematic safety, if you want to put it that way. Jackson Financial, one of those. It's an interesting company. They sell annuities. And annuities is a word that I think a lot of people know, but maybe they don't know exactly what an annuity is. Well, it's a stream of income that's guaranteed for the life of the individual. So you buy it, and then actuarially, they figure out how old you are and what capital you have, and they say, okay, with this much money, we will pay you this amount each month until you die.
Yeah.
There are variations off annuities. There are variable annuities. There are some risk-adjusted annuities now that anticipate or build in an underlying asset direction. So they might be based off the equity markets, for example, and you'll get a different answer than if you just invest in an interest-bearing vehicle. So Jackson has this business. They do about $8 billion a year, a $300 billion AUM book. The thing that attracted us was the fact that the management are all actuarially trained. They're very good at what they do. They're not always successful in all environments. They do better with a steeper yield curve, which we think we're headed towards.
That's right.
And they pay out a lot of their capital to their shareholders. For this year, they're projecting, I believe, $700 million of dividends and capital return to shareholders. And if you do the calculation, that represents 12% of their entire market cap.
Wow.
So they're a cash machine. They trade at 4.5 times earnings. Yeah,
Let's say that again.
Yeah.
Not book.
No.
4.5 times earnings, throwing $700 million back at shareholders.
Correct.
For a $6.2 billion company.
Yeah, and it's 0.6 times book value. The risk, of course, there's always the other side.
Yeah.
There's a reason for everything, is that if the environment doesn't work for them, they're going to go dormant for a period of time. But that's happened before. They're used to that. We think that they're set up with a backdrop that will lead to success.
Love these under the radar. One under the radar pick. The other two, we can at least have some comfort in Goldman and Morgan Stanley. Gordon, it's been an absolute pleasure. Thank you so much for joining me on the show.
Thank you, Amber. I've had fun.
Great. That's Gordon Reid joining us of Goodreid Investment Counsel. Make sure you watch our next episode. We've got Earl Davis on the show. He's head of fixed income at BMO Global Asset Management, and he's known for making his big calls, and he's been often right and sometimes contrarian on where he thinks interest rates are going and where he sees opportunity. We're going to find out, especially as we're on the eve of some major interest rate decisions by the Bank of Canada and the Federal Reserve at the end of this month. If you have questions about the macro, email us questions@inthemoneypod.com or find us anywhere on social media @inthemoneypod, and we'll see you on the next episode.